The stock market has always been about predicting the future, but today the tools being used to forecast market movements are more advanced than ever before. One of the most powerful and talked about technologies in modern investing is neural networks. These are a type of artificial intelligence inspired by the human brain, designed to recognize patterns, learn from data, and improve over time. In the world of personal finance and investing in the United States, neural networks are increasingly being used to forecast market trends, identify opportunities, and manage risk. Understanding how this technology works, where it excels, and where it can fail is critical for any investor who wants to stay informed and make smarter decisions. Neural networks work by analyzing massive amounts of historical and real-time market data, including price movements, trading volume, financial statements, economic indicators, and even alternative data like news sentiment. Unlike traditional models that rely on fixed formulas, neural networks adapt as new data comes in. They can uncover complex, non-linear relationships in the market that are nearly impossible for humans to identify. This is why hedge funds, quantitative firms, and now individual investors are paying close attention. When used correctly, neural networks can help forecast trends faster and with more nuance than traditional methods. One of the biggest opportunities neural networks offer is their ability to process and learn from enormous data. The US stock market generates a staggering amount of data every day, far more than any human analyst could reasonably handle. Neural networks can analyze this data continuously, spotting subtle shifts in momentum, volatility, and correlations between assets. This allows investors to identify potential entry and exit points earlier, adjust portfolios proactively, and avoid relying solely on lagging indicators. For long-term investors, this can mean better timing and more informed decision-making, rather than emotional reactions to headlines. Another powerful advantage of neural networks is their flexibility. They can be trained for different purposes depending on an investor's goals. Some models focus on short-term price movements and trading signals, while others are designed to forecast longer-term trends, economic cycles, or sector performance. For example, a neural network might detect early signs of a technology sector slowdown, or identify when defensive stocks are likely to outperform during economic uncertainty. This makes neural networks valuable not just for traders, but also for long-term investors focused on portfolio allocation and risk management. Neural networks can also incorporate alternative data sources that traditional models often ignore. Earnings call transcripts, social media sentiment, news headlines, and macroeconomic indicators can all be fed into a model to provide a more holistic view of the market. This broader perspective helps investors understand not just what is happening in the market, but why it might be happening. In a fast-moving environment, having access to this kind of insight can be a major advantage. However, while the opportunities are exciting, neural networks are not a magic solution. One of the biggest risks is overfitting. This happens when a model becomes too closely tailored to historical data and performs poorly in real-world conditions. Markets are dynamic, and patterns that worked in the past do not always repeat. A neural network that looks perfect in backtesting can fail when conditions change. This is a common mistake among inexperienced users who assume that more complexity automatically means better results. Another major risk is the black box nature of neural networks. Unlike simple models where you can clearly see how inputs lead to outputs, neural networks can be difficult to interpret. This lack of transparency can be dangerous if investors blindly trust predictions without understanding the underlying assumptions. In personal finance, especially for everyday investors in the United States, it is critical to remember that AI tools should support decision-making, not replace it. Relying entirely on a model without questioning its logic can lead to costly mistakes. Data quality is another key issue. Neural networks are only as good as the data they are trained on. Inaccurate, biased, or incomplete data can lead to misleading predictions. For example, if a model is trained primarily on bull market data, it may struggle during periods of high volatility or economic downturns. Investors must ensure that models are trained on diverse data sets that include different market cycles, including recessions and periods of extreme stress. One of the most common mistakes investors make with neural networks is expecting precise predictions. Markets are influenced by countless factors, many of which are unpredictable, such as geopolitical events, policy changes, or sudden shifts in investor sentiment. Neural networks can improve probabilities, but they cannot eliminate uncertainty. Successful investors use these tools to improve their odds, not to guarantee outcomes. Understanding this distinction is essential for maintaining realistic expectations and avoiding overconfidence. Another mistake is ignoring risk management. Even the most advanced forecasting model can be wrong. Investors who rely on neural network predictions without proper diversification, position sizing, and stop-loss strategies expose themselves to unnecessary risk. Neural networks should be integrated into a broader investment process that includes fundamental analyses, portfolio diversification, and a clear understanding of personal financial goals. Accessibility is improving, but education remains critical. Many AI-powered investing platforms now offer neural network-based tools to retail investors at affordable prices. This is a positive development, but it also means more people are using powerful tools without fully understanding them. Taking the time to learn how these models work, their limitations, and how to interpret their outputs is essential for long-term success. For U.S. investors focused on personal finance and wealth building, neural networks can be a valuable addition to the investing toolkit when used responsibly. They can help identify trends, manage risk, and make more data-driven decisions, but they are not a replacement for discipline, patience, and a long-term mindset. The most successful investors combine technology with sound financial principles and continuous learning. If you're finding this breakdown helpful and want more content like this, make sure to subscribe to the channel. We regularly share videos that simplify complex investing and personal finance topics so you can make smarter decisions with your money. Liking this video helps support the channel and ensures more people can access this kind of educational content. Drop a comment below and let us know your thoughts on AI and neural networks in investing, or share any questions you want us to cover in future videos. And if you know someone who is interested in the future of investing in financial technology, sharing this video could really help them. The future of market forecasting will continue to evolve as technology advances, but the fundamentals of smart investing remain the same. Use tools wisely, manage risk carefully, and stay focused on long-term goals. Neural networks offer powerful opportunities, but they also come with risks and potential mistakes. By understanding both sides, you put yourself in a stronger position to navigate the markets with confidence. This channel is here to help you build that confidence through education, clarity, and practical insights. By subscribing, liking, commenting, and sharing, you become part of a community focused on financial growth and smarter investing in the United States. Stay curious, stay disciplined, and remember that informed decisions today can lead to financial freedom tomorrow. Keep learning, keep improving, and I will see you in the next video.